We'll wrap up with just a few more additional topics related to long-term assets. Here, we'll still be dealing with transactions or other events that occur after the initial acquisition. For example, subsequent costs. After you acquire a long-term asset, it's often the case that additional expenditures will need to be made. Take an airline, for example. They've got aircraft that have been around for a decade or so, and the airline is going to incur a variety of costs related to keeping those planes going. Some of these might relate to basic repairs to address the wear and tear that the planes experience in the normal course of flying. But at other times, they might make more significant investments, like replacing all of the seating, adding touchscreen TVs. They might even replace the jet engines. Technically, these various types of costs can each take on nuanced categories, and the accounting treatment might be slightly different for each. For now, don't want you to worry about the nitty-gritty. The general principle we need to take note of here is that the costs that produce benefits that extend beyond the current period can be capitalized, whereas expenditures that simply maintain a given level of benefits are expensed in the period incurred. Next, just like inventory, it's possible that finite-lived fixed assets and intangibles can decline in value to the extent that it's necessary to record an impairment loss. Another way we'd put this is that their carrying amount may not be recoverable. So as circumstances indicate, we need to do an impairment test. And the test itself consists of first comparing an asset's book value with the sum of undiscounted future cash flows that the asset is expected to generate. And to make sure that you heard me right, yes, these are undiscounted future cash flows. This test does not take into account the time value of money. And in those situations where the book value is higher than the sum of future cash flows in raw dollars, then we would consider the asset to be impaired. However, as we proceed to calculate the size of the impairment loss, we're going to compare the book value to an entirely different number. Specifically, the impairment loss will equal the asset's book value minus its fair value less any relevant costs involved in selling it. And that fair value amount is probably a whole lot closer to the discounted future cash flow figure. So, just to review very briefly, the impairment test itself compares book value to the sum of undiscounted future cash flows. And because they're undiscounted, it's a higher threshold, making it harder to record an impairment loss. However, if that hurdle is cleared, we're going to write it down to something closer to its actual fair value. Students will sometimes conflate these two steps, so I ask you to pay careful attention to the distinction here. Lastly, it's probably time to revisit some financial statement ratios, right? As it relates to long-term or fixed assets, I'm going to present a couple of asset utilization or efficiency ratios, which seek to measure how well the company is using its asset base to generate sales and earnings and so forth. I want to start by talking about a more general total asset turnover, which equals total sales over average total assets. Whereas previously, when we've talked about turnover ratios that relate to accounts receivable and inventory, those express the number of times that an event happened during the year. But total asset turnover is going to take a different direction. Recall that I typically like to start with the denominator when interpreting what a ratio means. So we would say that for every dollar of total assets, how much revenue did the company generate? A total asset turnover ratio of 1.5 would suggest that every dollar of total assets resulted in $1.50 in terms of sales revenue the company was able to produce from that asset base. And this can be incredibly useful when you're comparing the profitability and sales of differently sized companies. They might be in the same industry, but when we scale this by the total size of the company in terms of assets, we can see how efficiently one company versus the other used that base to create sales revenue. Tying this more closely to the current unit, we can do this with just fixed assets, dividing total sales by average total PP&E. The interpretation's almost identical, except now we're focusing solely on those assets that constitute the productive capacity of the business. if we don't want to consider other things like accounts receivable, goodwill, and inventory, and just focus specifically on those large capital assets, we might use fixed asset turnover. For every dollar of fixed assets, how much revenue did the company generate? Well, we're getting closer to the end of the semester when we'll finally put all of these ratios together and do some more technical analysis.